Nearly $20 billion vanished into a banking labyrinth whose doors were scattered across continents. At the center stood the Bank of Credit and Commerce International, better known as BCCI, a global institution that appeared legitimate to customers, politicians, and investors while concealing losses, secret ownership, and criminal relationships. When regulators finally shut it down in 1991, the scandal revealed not merely a failed bank, but a financial architecture designed to prevent anyone from seeing the whole picture. BCCI was founded by Agha Hasan Abedi, a Pakistani banker who understood that international finance could be more than a business. It could be a shield. The bank expanded through London, Luxembourg, the Cayman Islands, and other financial centers, placing different operations under different legal systems. Each location could appear properly supervised in isolation, while the combined structure remained almost impossible to reconstruct. That fragmentation was not an accidental inconvenience, it was the mechanism. BCCI used layers of related companies, nominee owners, offshore accounts, and internal transfers to separate assets from liabilities and customers from scrutiny. A nominee owner is a person or entity listed on paper while someone else controls the underlying interest. The arrangement made accountability difficult because the name visible to one authority might conceal the beneficiary known to another. Abedi's ambition was matched by a distinctive psychological confidence, the conviction that personal networks could substitute for institutional transparency. BCCI cultivated powerful relationships and presented itself as a bridge between emerging markets, wealthy clients, and international capital. Its appeal rested on access. The more influential its customers became, the more dangerous it was for officials and business figures to ask how the bank truly operated. The deception depended on financial engineering that was less sophisticated than it was concealed. BCCI could issue loans to connected companies, move funds through affiliated accounts, and use new money to disguise old losses. Some loans were described as performing even when repayment was doubtful. In banking, a loan is an asset only if it can realistically be collected. BCCI's records often made that assumption look stronger than reality. This was creative accounting, a phrase that can sound harmless, but often means using flexible rules to make weak finances appear healthy. Losses could be postponed, obligations shifted, and transactions arranged so that one part of the organization seemed profitable while another absorbed the damage. The accounts did not simply record the business, they helped manufacture its appearance. The most important concealment was the separation between what regulators could inspect and what BCCI actually controlled. Auditors and authorities confronted a multinational structure in which records, subsidiaries, and legal responsibilities crossed borders. Due diligence, meaning the careful verification of ownership, assets, and risks, became fragmented as well. No single examiner necessarily possessed the mandate, records, or political access required to connect every piece. Then, the hidden relationships began to surface. Investigators found evidence of false loans, money laundering, and transactions involving related companies. Money laundering is the process of disguising funds derived from crime, so they appear to come from legitimate activity. BCCI's international footprint offered precisely the kind of distance that laundering requires: multiple jurisdictions, opaque ownership, and transactions difficult to interpret from any single location. The bank's customer network intensified the risk. Its clients reportedly included politicians, intelligence contacts, drug traffickers, and wealthy business figures. Their presence did not prove that every customer participated in wrongdoing, but it demonstrated how influence and secrecy could coexist inside the same institution. A bank that served powerful people could acquire something more valuable than deposits: the protection created by embarrassment, dependency, and political sensitivity. For ordinary depositors and legitimate businesses, the consequences were brutally simple. Confidence in a bank is an invisible asset built from the belief that deposits are recorded accurately and withdrawals can be honored. When that belief collapses, customers do not experience accounting theory. They face uncertainty over savings, contracts, employment, and commercial relationships. The damage spreads far beyond the individuals who created the deception. The failure also exposed a fundamental weakness in global banking oversight. National regulators were organized around national institutions, but BCCI was organized around the gaps between them. London, Luxembourg, and the Cayman Islands each formed part of a wider network. Yet responsibility could be divided among authorities that did not share the same information or legal powers. The bank exploited jurisdictional boundaries as if they were protective walls. That strategy raised a troubling question. Was BCCI evading oversight, or was the international system inviting it to do so? Offshore finance is not automatically illegal. It can serve legitimate commercial purposes. The vulnerability arises when secrecy prevents authorities from identifying the real owners of companies, tracing the movement of funds, or measuring a bank's total exposure. BCCI turned opacity from a side effect into an operating principle. As scrutiny intensified, the institution's public image became increasingly difficult to reconcile with its internal reality. Analysts and investigators examined loans that appeared connected to the bank's own interests, transactions that shifted risk among affiliated entities, and balance sheets that concealed the scale of deterioration. A balance sheet is supposed to show what a company owns, what it owes, and what remains for its owners. At BCCI, that clarity was precisely what the structure obstructed. The political dimension made the unraveling slower and more complicated. Access to influential figures could create hesitation among institutions that might otherwise have intervened earlier. No single act of protection needed to be formally ordered. Delay itself could be valuable. Every postponed inquiry allowed more accounts to move, more records to disperse, and more losses to be transferred beyond immediate detection. The hidden accounts were therefore not just repositories for money. They were instruments of time. They extended the life of a failing institution by allowing management to postpone recognition of losses and sustain the appearance of liquidity. Liquidity means the ability to meet obligations as they come due. A bank can look prosperous on paper and still be unable to survive a serious demand for cash. The collapse became unavoidable when the gap between reported strength and underlying reality could no longer be contained. Regulators shut BCCI down in 1991, ending an international banking operation whose complexity had delayed accountability. The closure did not erase the damage. It initiated criminal cases, lawsuits, investigations, and years of questions about who knew what, when they knew it, and why warnings had not produced earlier action. Estimates of the losses varied because the records themselves were incomplete, dispersed, and contaminated by false reporting. Some investigations placed the wider financial hole near $20 billion. That figure should be understood as an estimate of the broader damage and concealed exposure, not as a single proven cash withdrawal from one account. The uncertainty was itself part of the scandal. When records cannot establish the truth, deception has already achieved a secondary victory. The economic ripple extended into the credibility of international finance. Customers and counterparties were forced to confront the possibility that a bank with offices, auditors, and regulatory relationships across several countries could still operate as a concealed network. Markets depend on information moving faster than fear. BCCI demonstrated what happens when information is deliberately trapped inside legal compartments. Its legacy also reached the architecture of financial supervision. Regulators increasingly faced pressure to share information across borders, identify beneficial owners, and examine consolidated risks rather than isolated subsidiaries. Beneficial ownership means the person or entity that ultimately controls or profits from an asset, even when another name appears in official records. Without that knowledge, enforcement can become a search through shadows. Yet regulation alone cannot explain why the scheme endured. Institutions failed when they accepted reputation as evidence, treated complexity as sophistication, or assumed that another authority was responsible. Auditors can test records, but they cannot guarantee honesty when management controls the information flow. Regulators can issue rules, but rules become fragile when agencies compete. Jurisdictions protect secrecy, and powerful clients make scrutiny uncomfortable. The deeper betrayal was therefore institutional. BCCI did not merely deceive depositors. It exploited the trust placed in professional systems designed to detect deception. Its story shows how greed becomes durable when distributed across many hands, each responsible for a narrow task and insulated from the full consequence. Who is accountable when everyone sees a fragment, but no one is compelled to assemble the whole? BCCI's secret accounts eventually became evidence of a larger truth. Financial fraud does not require every participant to understand the entire scheme. Some may falsify records, others may move funds, others may overlook warnings, and still others may benefit from delay. The system can become corrupt without every individual sharing the same motive. What matters is whether the structure rewards silence more reliably than it rewards truth. The 1991 closure ended BCCI as a bank, but it did not end the conditions that made BCCI possible. Cross-border finance remains vulnerable wherever ownership is hidden, oversight is divided, and political influence blurs the boundary between legitimate access and protected impunity. The estimated $20 billion hole was the measurable wound. The lasting damage was harder to calculate. Public trust diminished, institutions discredited, and the world reminded that a bank can appear global, respected, and carefully regulated while being designed to keep every authority from seeing everything.